Welcome to Day 87 of Future Business School's Daily MBA. Today, we're diving into the world of financial modeling and forecasting, an essential skill for anyone looking to understand and predict a company's financial performance. We'll explore what financial modeling is, how to create pro forma financial statements, and the key principles of forecasting future business outcomes. What is financial modeling? Financial modeling is the process of creating a mathematical representation of a company's financial situation. These models are used to make informed business decisions by analyzing the past and forecasting the future financial performance of the business. Financial models typically incorporate variables like revenues, expenses, capital structure, and growth projections to simulate different scenarios. In essence, financial modeling acts as a tool to answer questions like, what will our earnings look like if sales grow by 10% next year? How will changes in operating costs impact profitability? What's the expected return on a potential new investment? Financial models are invaluable for investment analysis. Investors use models to determine if a company is worth investing in. Corporate finance. Companies rely on financial models to evaluate mergers, acquisitions, and capital investments. Business planning. Entrepreneurs and business leaders use financial models to support strategic decision-making. Components of financial models. Financial models usually consist of several key components that work together to provide a comprehensive view of a business's financial outlook. Income statement. The income statement shows a company's revenues, costs, and profit over a specific period. Key components include revenue, sales or income generated from operations, cost of goods sold, COGS, direct costs associated with producing goods or services, operating expenses, costs like salaries, rent, and utilities, net income. The company's profit after all expenses are deducted from revenues. Balance sheet. The balance sheet provides a snapshot of a company's assets, liabilities, and shareholders' equity at a particular point in time. It's based on the equation: assets equal liabilities plus shareholders' equity. Key balance sheet items include assets, cash, accounts receivable, inventory, and fixed assets like buildings. Liabilities, debt, accounts payable, and other financial obligations. Shareholders' equity. The value remaining after liabilities are subtracted from assets. Cash flow statement. The cash flow statement tracks the flow of cash in and out of a business. It is divided into three sections. Operating activities. Cash generated or spent through day-to-day operations. Investing activities. Cash used for investments in assets like property, equipment, or acquisitions. Financing activities. Cash from raising capital like issuing stock or debt or repaying investors. Creating pro forma financial statements. Pro forma financial statements are forward-looking statements that forecast future financial performance based on certain assumptions. They include projected income statements, balance sheets, and cash flow statements, and are often used for business planning, fundraising, or evaluating investment opportunities. Steps to create pro forma statements. Revenue projections. Start by estimating future revenues based on historical data, market trends, and company goals. Estimate costs. Use historical trends to forecast COGS and operating expenses. Be sure to account for potential changes in input costs or wages. Capital structure. Forecast changes in the company's debt and equity structure, particularly if the company plans to raise capital or repay debt. Profitability. From your revenue and cost projections, calculate gross profit, operating profit, and net income. Cash flow. Forecast operating, investing, and financing cash flows based on your revenue and expense projections, as well as expected changes in capital expenditures and debt repayments. Pro forma financials help businesses and investors make strategic decisions by understanding what financial results might look like under different assumptions. Financial forecasting involves predicting a company's future financial performance based on a combination of historical data and assumptions about future conditions. Forecasting helps businesses anticipate financial results, budget for expenses, and plan for growth. There are two main types of forecasting. Quantitative forecasting uses historical data and mathematical models to make predictions. Common methods include time series analysis, analyzing patterns and trends in historical data to forecast future performance. Regression analysis, a statistical method that identifies relationships between variables like sales and marketing spend and uses them to make predictions. Quantitative forecasting is data-driven and is often used when there is ample historical data available. However, it assumes that past trends will continue into the future, which may not always be the case. Qualitative forecasting relies on expert judgment and market insights to predict future outcomes. Methods include market research, surveys, interviews, and focus groups to gather insights on customer behavior, preferences, and buying patterns. Delphi method. A group of experts provides input to make collective predictions about the future. This type of forecasting is particularly useful when historical data is limited or when external factors, like regulatory changes or new market entrants, are expected to impact the business. Best practices for financial forecasting. Accurate forecasting is essential for good financial planning. Here are a few best practices to keep in mind. Use multiple scenarios. It's important to create multiple scenarios, best case, worst case, and base case, to account for uncertainty. For example, in the best case scenario, revenue might grow by 15%, while in the worst case scenario, it may shrink by 5%. This helps you prepare for different outcomes and make more informed decisions. Stay conservative with assumptions. It's easy to get overly optimistic with forecasts, but it's important to stay conservative. Overestimating future revenues or underestimating costs can lead to poor decision-making and financial distress. Regularly review and update forecasts. Business conditions can change quickly, so it's essential to regularly update your forecasts to reflect new information. Factors like market trends, economic conditions, and competitor actions should be incorporated into your updated forecasts. Leverage technology. Modern financial modeling software like Excel, IBM Planning Analytics, or Adaptive Insights can help streamline the forecasting process and reduce errors. These tools allow you to build complex models, test scenarios, and generate reports efficiently. The role of financial models in business strategy. Financial models play a critical role in formulating business strategy. By offering a clear view of how decisions will affect a company's financial performance, they help business leaders assess the viability of new projects or investments, make informed decisions about resource allocation, identify potential risks, and develop contingency plans, track performance, and ensure alignment with financial goals. Key takeaways. Financial modeling is essential for forecasting a company's future performance and making informed decisions. Pro forma financial statements provide a forward-looking view of a company's financial health, helping with planning and investment. Forecasting methods, both quantitative and qualitative, enable businesses to anticipate future outcomes and prepare for uncertainty. Best practices include creating multiple scenarios, being conservative with assumptions, and regularly updating forecasts. Thanks for watching Day 87 of Future Business School's Daily MBA. Be sure to like, comment, and subscribe, and join us tomorrow for another exciting business topic.